Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and our topic today is deferred tax, multiple temporary difference. Usually, when we see in the textbooks and so on, they work with only one temporary difference. For instance, depreciation or deferred revenue and so on. Today, we will combine both. We will combine uh, one deferred tax liability and one deferred tax asset. And when do we have deferred tax liability? When we have future taxable amounts. The total of the future taxable amount then is multiplied by future tax rate to determine the appropriate balance for the deferred tax liability. So we don't pay tax now, we will pay in the future. So we have deferred tax liability. Deferred tax asset, when we have future deductible amount, we pay more tax now, we will pay less tax in the future. So the total of the future deductible amount is multiplied by future tax rates to determine the appropriate balance for the deferred tax asset. So let's go to our Excel file and double check it. Here on this Excel file, we have one deferred tax liability and one deferred tax asset. That is our first video about deferred tax. Permanent difference, a second video about deferred tax, and multiple temporary difference. That is this video. All of the other two videos, they are in our video description, as well as our Excel file. They are all free to download, and the link is in our video description. So here, the first temporary difference, the second temporary difference. Skyping Corporation purchased 100,000 of equipment in early January of 2020. Useful life 3 years, so 40,000 per year. Uh, Straight line method. However, tax rules allows Skyping to take the depreciation in 2 years. So we will pay less tax now, more tax in the future. We have a deferred tax liability. On the other hand, 2020 income statement does not include 100,000 of magazine subscription received that year for 1 and 2 year subscription. Instead, that revenue will be recognized for financial reporting purpose in 2021 and 2022. Uh, and here is not 1,120, is 1,000. However, for tax law, we have no deferred revenue on this scenario, and we pay tax all in 2020. So we will pay more tax in 2020, less in 2021 and 2022. So for this second scenario here, uh, we have a deferred tax asset, and the income tax rate is 25%. So here is what we have. Pre-tax accounting income, depreciation expense, we add it because it was deductible in the income statement, and we exclude the depreciation expense in tax return. As well as we subtract the subscription revenue in the income statement, nothing in 2020, negative 90 2021 and 10 2022, and we add the subscription revenue on the tax return. So the temporary difference 80, negative 110, 30, so total 0, so all temporary difference. And here the taxable income. Okay, so pre-tax plus temporary difference. And so the first one, depreciation. We have here our depreciation. So our taxable income, uh, 280, depreciation negative 20. When we combine both, Deferred revenue 100 when we combine both. And here we will have one temporary difference. The future taxable is positive. We will pay more tax. So we have deferred tax liability. The second one, negative 100 for future deductible, negative here. So we have deferred tax asset. We cannot combine both in the US. There are some countries that you can combine both. Here in the US, you can't. So you need to work with deferred tax liability and deferred tax asset. So deferred tax liability. So tax payable, 70 to 80 times 25%. Ending balance and the change, we need to split it in deferred tax liability and deferred tax asset. Deferred tax liability, 5, our ending balance. So the change, ending balance less beginning balance, positive 5. Deferred tax asset, the same, 25, our ending balance, 0, beginning balance, change is 25. Tax expense plug, easiest way, based on journal entries. So what do we do here? Deferred tax liability, 70. Deferred tax asset, if we are increasing our deferred tax asset, it is a debit, 25. We are increasing our deferred tax liability, so it is a credit, 5. So income tax expense is the number to balance. It is our credits less our debit. It is 50. Okay? 2021. We have the current year, future years here. So what do we have? Future taxable, 40 times 25%. So the ending balance will be 10. Beginning balance 5. Our change is 5. Future deductible, negative 2.5. So 2.5, our ending balance. Beginning balance, 25. So our change is negative 22.50. And uh, tax rate here is also 22.50. Coincidence here, guys. So our tax expense, number to balance, income tax payable, 22.5. Our asset, we are decreasing our assets, so we have a credit. Negative here, then our number becomes positive. If you have tax liability, we are increasing, so another credit, 5. And income tax expense, the number to balance is the sum of our credits. It is 50 again. And 50, why? Because our pre-tax income, county income is the same. And income tax rate, 25. 25% of 200, it is 50. So it will be 50 all the time. And our effective interest rate is also 25% because we have only temporary difference. 2022, nothing else on ending balance because they are temporary difference. So uh, taxable income 230, tax rate 25%, so tax payable 55. No ending balance. So for the deferred tax liability, nothing less 10, negative 10, decreasing 10. Asset, nothing less to 50, decreasing to 50. The last year, we will only have decreasing changes because our ending balance must be 0, must be nothing. Here, negative 10, negative 250. So let's delete it here. Let's do it again. Income tax payable, 57. Deferred tax liability decreasing, so we need a debit, 10. Asset decreasing. We need a credit now to 50. And the income tax expense, it is, whoops, some of our credits less our debit here, $50,000. And how do we present it in our balance sheet? Deferred tax asset, long-term assets, deferred tax liabilities, deferred long-term liability or non-current liability. So we cannot combine both in the US. Remember that, guys. Never combine them. So guys, subscribe our channel. You will be the first one to know when a new video arrives. Like our Facebook page, Accounting Hub by Dr. Scarping. If you have questions or comments, leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.